Is Uncle Broker taxing your commission too much
without giving the support that you signed up for? Don't be a victim of outdated broker models. It's time for an upgrade.
Here is a golden chance to make 100% commission
with London Foster. London Foster's main goal is to empower an associate and make sure you, the realtor, are getting the most out of your hard work and commission. With an excellent proven track record, latest tools and technology, and exceptional experience, we strive to create the perfect environment for our associate, providing multiple opportunities for you. No hidden fees and no gimmicks. 100% commission for our associates by empowering you with the benefits like
a personalized website with IDX searchability, simulcasting your listing to sites like Realtor.com, Zillow, Trulia, and different search engines for brand recognition. An office at the famous Lincoln Road.
Direct broker support and free weekly and monthly training from Realtor.com and other partners. A personal business trainer resolving all your queries. In-house private equity fund. No waiting on checks. Get it on the closing day.
We understand it's a very competitive market out there. The old broker models don't work anymore. And you deserve more for your hard work. So it's time you give yourself an upgrade with London Foster.
Good morning, everyone, and welcome to another London Foster Pro training. Today is a very special day. As we do every other Wednesday, we are having an online training hosted by one of our many vendors. Today, it is Stephen Gurian with Easy Probate. Did I say that right?
Easy Estate Probate, but I'll forgive you.
Easy Estate Probate. It's not in your auto signature, so you might want to add that.
Oh,
Easy
gotcha.
Estate Probate. And as I said, I'm going to be sharing his information on the chat room. Stephen has signed up to give us 3 more trainings this year. All of them are continuing education, so you get 2 hours credit. Who's excited about that? I know everybody goes crazy at the end of the year. Well, guys, if you plan ahead and you do it, thank you, Anthony. If you plan ahead and you do it, guess what? It really eats up those hours, and you can actually do quite a bit with us here at London Foster. I am sharing his information in the chat room. I'll be sharing it several times throughout the training. So guys, copy, paste that, save his number, put him down as Stephen, the probate guy. He's going to be going over a little bit about what our services or his services are in regards to, helping agents and helping deals come to fruition. For those of you that are not London Foster agents, I want to welcome you. I am going to show you a little bit about what we do. London Foster is a hybrid kind of company. We have 7 locations in South Florida, over 1,400 agents, and we are quite the novel company because, like many other companies that have physical offices, we do provide physical offices. As you can see right now, I'm in the Kendall office, but we also provide you with a platform that just makes your job a lot easier. Basically, there is no reason for an agent to come into the office other than to come say hi, because we do everything online. And one of the really cool features about London Foster, and I'll show you guys really quick, and I go over this in the London Foster 101, which I'll send you guys the information online so you guys can register. But we did something really special, which is that, I don't know if you've ever been to a website, you fall in love with it, you get used to it, and then all of a sudden you download the app and it looks nothing like it and you're totally lost. Well, we did something really clever, which is that we designed our website for the phone. So instead of adapting a website to your phone, we made it for the phone and we actually adapt it for the internet, for your computer. So what is that? What's so genius about that? Well, if Trish has a check for $80,000 that she needs to deposit, guess what? She takes a picture of the check, deposits it, takes a picture of the receipt, and now she has the three things she needs in order for her to request an escrow letter on her phone. She doesn't have to download it, email it, forward it to herself, make sure she gets on the computer. No, she's ready to go. And that's the idea. The idea is that all of our transactions are able to be done mobilely. If Gloria Hoyos is at a closing and she says, you know what, I just closed this property, I need to do a postcard. She's able to do this from her phone. Where are the pictures of the property? Where's her headshot? Yeah, she probably has it on her computer in a file, but more than likely it's on her phone, right? So that's the idea. So I'm going to show you guys really quick my screen. For those of you that are not London Foster agents, I invite you to visit the joinlondonfoster.com page. Great little section right here, FAQ. 99% of what you want to know is there. So most definitely visit it. We also have this video where Bobby comes and he explains to you a little bit about the company's about. He goes over, hold on, I wanted to mute him. He goes over the 5 core principles of London Foster, which is broker support. We have a 1-844 number where you can call anytime from 9 to 5, Monday through Friday. We have a chat room where you can provide or ask her questions. Marketing support, we have an entire plethora of marketing pieces that you can get done for free. You don't have to pay for anything. Obviously, the implementation of a marketing piece, be it a business card, a banner, whatever it is that you want to print out, you're able to do that on your dime. But everything that's creation, the whole creative part, is free. We have an escrow account, like I mentioned before. You're able to hold escrow at London Foster. The great thing about holding escrow at London Foster, and most of you know this, is guess what? You get paid first. If we're holding $80,000 for Trish, and Trish's commission is $30,000, Trish, am I going to send those $80,000 over to the title company and then ask them to wire me back? No, I'm going to keep your money and send the remaining amount over to the title company. Guess what, Trish? The day after your closing, when you presented all your paperwork, your final HUD, you're getting an e-check. So Trish is able to actually print her check from her house and deposit it with her phone. She wants to take a shower that day, she can do it. She doesn't want to, she wants to stay in her jammies, she just deposited her check. That's the idea. We also have a online technology, which I'll show you guys in a second. And last but not least, we have the locations. Like I said, we have 7 locations in South Florida, and they're all open to all of the agents. So just because Jose might live in, I don't know, downtown Dadeland, and that's his office, doesn't mean he can't visit the office in, I don't know, Lehigh Acres one day when he's there. All the offices are open to all of our agents. Onboarding is super simple. All you have to do is just click on this join button. There is a 3-part form to fill out. Once you fill that out, it'll ask you for your IDs and you're ready to go. The back office, I just want to show you guys really quick. When you need to look for a vendor, you're able to look for them here. I've had a lot of people asking me, I don't know why, but for the DBPR information, do you think anyone's nervous that they haven't completed their continuing education or they haven't paid their fees? Guys, all of the information is here provided for you. So that is the idea. The idea is that we have all of it available for you at your fingertips. I talked a little bit about escrow. Let me show you guys really quick. If you're a London Foster agent, you are able to apply for an escrow deposit card. So what does that mean? That means that you fill out this little form, and in a matter of 21 days, they will mail you an actual ATM card for you to make your escrow deposits. Memo, does it work for our commission? No, it's called an escrow deposit card. But the great thing about it is that when Trish had that $80,000 right in her hand, she has to either A, drop it off at the office, B, mail it, C, go to the bank and deposit it. Well, with this, you can just do it straight from the ATM. So it makes her life a lot easier. For those of you that are looking at how you do an escrow deposit, all you have to do is just click here. You fill out a quick form, upload the picture of the check, upload the picture of the receipt, and within 15 minutes, you're going to have an escrow letter in your email. So just think about this for a second, guys. I'm presenting an offer to Robert, and so is Roger. But guess what? Robert is super excited to work with me because he thinks I'm the cat's meow, but I just presented an offer. Roger has an escrow letter. Changes the game a little bit, right? Makes him look a lot more serious and makes Robert a lot more eager to be working with Roger because Roger's got money held up already on this deal. My offer just says, I swear to you, Robert, my client in 3 days will give you $80,000. That's very different. So just know, guys, that all of this is available to you guys. Like I said, if you ever need to reach out to your broker, all you have to do is click on the logo, scroll down to the bottom. You're going to have the broker's information, your manager's information, and the office information, including the 1844. Okay. If you have not attended the London Foster 101 and you're a new agent, I highly recommend that you visit us and you do that. You can always go to Getting Started, London Foster 101, and fill out that form, and they will send you a link so that you can participate. We do this call 4 times a week, guys, Monday, Friday, Saturday at noon. And tomorrow, Thursday, I'm doing one at 7 p.m. For those of you that are not London Foster agents and you're curious, do not worry. I will be sending you an email with all the instructions on how to attend this meeting. Okay. Last but not least, let me get out of here. Let me let people in. Last but not least. Okay, let me just reiterate to everyone, this is a continuing education class. It counts for 2 hours of continuing education. So I will be sending everyone the information on Stephen Gurian so that you can actually attend and get credit for it. One of the ways that we're going to do this is that at the end, Stephen is going to give out a password. Everyone has to email him. He has a whole list of everyone who RSVP'd. So all you need to do is just email him your first name, last name, and your license number, and he will be able to assign a credit. Correct, Stephen? Is that the way it works? Beautiful.
Yep.
Okay. Let me just make sure. I see some thumbs up. Thank you, guys. Come on, guys, share those screens. What's going on? We have a guest with us. Thank you, Miss Lillian. Come on, guys. You're making me look bad. Everybody, come on, let's share those screens. But anyway, we're going to go ahead and get started. Stephen, I want to thank you, first of all, for taking the time to do this. It's a great asset to us as a team. We definitely appreciate it. Guys, know that this training is recorded for all the London Foster agents. You're able to find this in the back office under education. It'll take around 5 days for it to come up. So probably by Monday, it'll be up once we edit it and we have added everything. Stephen has also emailed me, correct, the PowerPoint that he's going to be using. So we're going to provide that for you in the back office. I want to thank Stephen for doing this. And Stephen, I will be quiet now and give you the floor.
Gotcha. So what's up, guys? My name is Stephen Gurian. I'm an attorney. Been practicing law for about 12 years. And what I do mostly is, all the sexy stuff. So tax, estate planning, probate, things of that sort, 1031s. So all that exciting stuff. So today, this is a 2-credit course. And this is, FREC, this is DBPR, not me, but in order to get credit, you have to have your cameras on, you have to, pay attention. And like Memo said, at the end of the course, I will give you a password and then just send that to me along with your first name, last name, and license number. And then I'll give you guys the credit. And if you don't want credit, it's okay. You don't have to email me. But that's the procedure from DBPR if you want credit. So today we're going to talk about purchasing and selling real estate for international clients. So the idea of today's course is for you guys to get a basic understanding of the best way to structure purchases, how to structure sales when we're dealing with a non-US citizen or a non-resident alien. Hopefully today you also learn about issues that you guys should spot when representing a non-US citizen, that's looking to sell or purchase real estate. So we'll talk a little bit about FIRPTA. We'll talk a little bit about structuring transactions to avoid FIRPTA. Talk about who pays FIRPTA and the procedures for withholding. We'll go on to talk about some exceptions to FIRPTA and some practicing tips. We'll talk about how to structure the purchase of real estate when you're dealing with a foreigner, how to structure the sale, what entities non-residents should use when buying real estate. And we'll talk a little bit about taxes, estate tax and gift tax, when you own real estate, both for non-residents and US citizens. So that's essentially what we're going to talk about today. Let me share my screen. All right, hopefully you guys all see that. So, and by the way, if anyone has any questions, feel free to put it in the chat. I'll do my best to keep an eye on it while we're going along. 1 second. Whoops. All right, perfect. So again, my name is Stephen Gurian. You have my info there on the slide, and it's also been put in the chat. So I'm a partner at Easy Estate Probate and also at our sister company affiliated 1031. So what we focus on is, probating real estate. So if somebody dies and they own real estate, we help get that real estate sold or to pass it on to, the wife or kids or whoever, the case may be, whoever the heirs are. That way you guys can get to the closing table on time, every time. We also deal a lot with foreigners. So believe it or not, like the quitclaim deed, and we'll go over this in a little bit, is probably like the worst enemy of a foreigner, because you actually have to withhold FERPTA anytime a foreigner transfers real estate. So we'll talk a little bit about avoiding, that kind of a trap. And then also we do 1031 exchanges. So if you know anybody that's an investor and they're looking to sell and purchase something new, with a 1031 exchange, you could actually avoid paying taxes on that sale as long as you invest those proceeds in a new property. And you could actually 1031 until the day you die. So it's possible to keep doing a 1031 exchange and then never pay taxes on the sale of real estate. So in a nutshell, that's kind of what we do. So let's talk a little bit about non-residents. You'll probably hear me call them like NRAs for short. So what is it that we need to look out for when we're dealing with an NRA, international client? So like I said earlier, FERPTA. And FERPTA is probably the biggest thing here, at least something I deal with a lot being in South Florida. And it's something that's easily avoided too. So we'll talk about structuring purchases and sales to avoid this. Again, we'll talk about estate tax, gift tax, and what entities, people could use. A lot of foreigners, believe it or not, will open up an LLC. It'll be a single member LLC, and they think they avoid FERPTA, and that isn't the case. So believe it or not, a single member LLC where the sole owner is a non-resident alien or a foreigner, gotta withhold for FERPTA. So let's talk a little bit about planning for the international client. So we'll get some of the boring stuff out of the way, and then we'll talk about the more exciting stuff like structuring the deals. But let's get a basic understanding of what it is that we need to look out for. So when we're servicing international clients, the planning applies to anyone that has property in more than one country, or anyone that has family members who are residents of or are domiciled in more than one country. So from our perspective, from the US perspective, it usually involves a foreign client that has assets here in the United States. And it doesn't necessarily have to be real estate. It could be a bank account, but anything that's located in the US that they own by themselves or with family members that are located in the United States. So always consider like the residency or the citizenship of a potential buyer or seller when they're looking to purchase real estate. And also think about their spouse as well. So what is citizenship, residency, domicile? Like a lot of that, probably sounds the same, right? But from a tax perspective, it's a little bit different. And we're going to talk a little bit about income tax. So that's money that you make while you're alive, and then estate tax. So if you pass away owning something, that value is actually taxed, especially if you're a non-resident alien. So from the income tax perspective, a U.S. resident is somebody that's been here at least 183 days within a 3-year period, or they have a green card. So that's what residency is from an income tax perspective. Now, from an estate tax perspective, a resident or somebody that passed away, a decedent, is a resident decedent who at the time of their death had their domicile here in the United States. So you don't even necessarily have to be a citizen to be an estate tax resident for U.S. tax purposes. Like, maybe you lived here, you had a visa, or you had a green card, and you were never planning on leaving. So you don't necessarily have to have that citizenship to be taxed as a U.S. citizen from an estate tax standpoint. And that's huge. And we're going to get to it in a second, but that's a really big benefit that citizens get, from an estate tax perspective, is being taxed as a U.S. citizen. Now, estate tax liability, like I was saying, is determined by domicile, which is, it's subjective. It's the place where a resident lives with no intention of leaving. And it's, based on multiple factors. Do their kids go to school here? Is there work here? Do they invest in the United States? It's a very subjective test. So even if you don't have that citizenship and you're just a green card holder or a permanent resident, the IRS is going to look at, subjectively, what it is that you're doing in the United States, to essentially, become a citizen, quote unquote, or to avail yourself to becoming a U.S. domicile. So we talked a little bit about it. So citizenship, or I'm sorry, residency. So you got that green card test. Are you a lawful permanent resident? And then there's something called the substantial presence test. So if a non-resident alien passes the substantial presence test, essentially, if they were physically present in the United States at least 31 days in the current year, or the year that you're going to file a tax return, and the total number of days in the present tax year plus a look back period of 3 years equals 183 days, you're a U.S. resident for income tax purposes. The math is kind of funky though. So let's say we're trying to figure out the test now in 2023. You get credit day for day, the amount of time you've been in the U.S. So if you've been in the U.S., 120 days, in 2023, you're here in the U.S. 120 days in 2023. However, when you go back to 2022, when you go back to a second year, you only get credit a third the number of days in that year. So if you're here 90 days in 2022, you're only, for income tax purposes, really here in the United States for 30 days. And then when you go back to the third year, you only get 1/6 the number of credit for the days that you've actually been in the U.S. So as long as those total up to 183 days, you're a U.S. Resident for income tax purposes. And that's big because a lot of people don't necessarily get the green card, but if you meet that substantial presence test, you don't actually have to withhold for FERPTA, and the transaction is exempt. So how is it that non-residents are taxed in general? So basically what their gross estate is made up of is, their assets that are here in the United States, that are situated in the United States. They call it a U.S. situs asset. And estate tax rates for U.S. persons and non-residents are identical. So, if you're a foreigner or a U.S. citizen, the highest rate is 40%. Doesn't matter, where you're from, the rates are identical, just like income tax rates. Like the highest rate is 37%, for the income tax side. However, the main difference is that U.S. citizens get a $12.92 million per person exemption against the estate tax. What does that mean? That means that if you are a U.S. citizen and you die with under $12.92 million of assets, you don't pay estate tax. But for every dollar you're above that exemption amount, you have to pay 40% over to the IRS. And guess what it is for non-resident aliens? It's only $60,000. So any non-resident that bought that condo in Brickell, clearly it's worth more than $60,000. For every dollar above that $60,000 mark, Uncle Sam is going to take, 40 cents away. So add a couple of zeros to that, and it's, real money, potentially. That $600,000 condo, almost half of it's going to go to the IRS, if that person passes away. But there's ways to avoid that. And funny enough, this credit has not been increased for non-resident aliens, but it has for us as U.S. citizens. It increases every year to account for inflation. This actually used to be, back in 2010, $5 million. But now it's almost at 13, and it's going to keep going up until 2025 when this law is going to expire. So it's going to go back to 5 million adjusted for inflation. We don't know the exact amount yet, but if Congress doesn't extend this law, past 2025, basically anybody that owns a house in Coral Gables is probably going to be paying estate tax to Uncle Sam. So let's continue talking a little bit more about planning for the international client. So what specifically is subject to estate tax? So for our purposes, it's real property located in the United States. Anytime a non-resident owns real estate directly, or even if it's through a C Corp or an LLC or a partnership, that is included in their estate for counting towards that $60,000, credit they have against the tax. And you have to include that, God forbid they pass away and you have to file a tax return, and all that is subject to tax. And again, for them, it's the high rate of 40% over, $60,000. So structuring these deals in such a way that they could avoid this tax is huge. And then you guys, you'll basically look like rock stars if you could, issue spot this ahead of time, and definitely get it done before closing. So what else is treated as a U.S. asset for estate tax purposes? Essentially any kind of tangible personal property in the U.S. So cash in a bank account, stocks and bonds, rental income, basically anything that generates income for a foreigner is treated as a U.S. asset for computating this calculation of estate tax. And there's certain exceptions, like if you just have cash in a bank account that isn't connected to a business, then that doesn't actually count towards the $60,000. So you could have $1 million in a bank account. As long as that cash isn't derived from a U.S. trade or business, doesn't count towards the $60K, and they don't have to pay the 40%. But if it is, if it's what's called effectively connected income from a U.S. trade or business, then you got to pay that estate tax. So why does all of this matter? Why are we kind of getting into the weeds with all this tax talk? So it's possible to eliminate the estate tax for non-resident aliens with proper planning. So remember that estate tax on non-resident aliens is based on the assets that they own that are located in the United States. So implementing a proper structure to hold real estate, for our purposes, can eliminate this estate tax completely. So if you know of an NRA that's looking to buy real estate, we could set up a structure ahead of time, prior to closing, so that you eliminate estate tax in case, something happens to them, and you could eliminate having to withhold for FERPTA. So this is a typical structure that we use for non-residents when they're looking to avoid, some of these taxes. So if you look here, we have our non-resident. And I know this drawing is a little crude, but it gets the job done. So we have this piece of real estate here, right? And it's owned by a Florida LLC. That Florida LLC is owned by an offshore corporation, and we like to use Nevis here in the office because it's cheap and it gives you some kind of anonymity. What used to be really popular back in the day was BVI, but the laws have changed in that. I want to say like 6, 7, 8 years ago, somewhere around there, and they actually publish a list of the people that own these companies. So think of Sunbiz, where everything is like public record, and you see who owns what company. BVI is like that now, and it didn't used to be the case, but Nevis still has that anonymity to it. And by the way, this is completely legal. There's nothing illegal about this. You're not, dodging taxes or anything like that. You're just, tax planning. So then who owns this Nevis Corp? We have the non-resident. So applying what we learned, this is how we're going to avoid estate tax. So remember, estate tax applies to individuals, doesn't apply to entities. Why? Because people die, entities don't. So a company can live on in perpetuity. So you're never going to tax estate tax on a company. But us, yeah, eventually, we die and we own assets when we die, and we have to, pay taxes on that. So estate tax, again, only applies to individuals. So if that individual owns a foreign corporation, not a U.S. corporation, but a foreign corporation, obviously they can't be, they can't be taxed U.S. estate tax. And now this foreign corporation owns this U.S. LLC, and then this U.S. LLC owns the real estate. So why is this part important? Because if you have a Florida corporation or Florida LLC taxed as a C Corp, you could actually avoid FERPTA, because FERPTA applies to a foreign seller of real estate, whether it's a foreign company or a foreign person. But because in this example, because this Florida LLC is taxed as a C Corp, it's a U.S. entity that owns real estate. If it ever sells it, FERPTA doesn't apply because, again, it's a U.S. company that owns the real estate. And if this person passes away, indirectly owning this real estate, estate tax doesn't apply because he doesn't own the real estate. He owns an interest in a foreign entity that owns a Florida entity that owns the real estate. So you have these two blockers. You've got your estate tax blocker up here, and then you have your FERPTA blocker down here. So this is a pretty common structure that we use to avoid having to withhold at the property level and to avoid non-residents having to pay estate tax. Now, if this person ever becomes a citizen, you're taxed on worldwide income, but your exemption increases from 60,000 to almost 13 million. So that's one of the benefits of becoming a U.S. citizen. Let me see. Let me look at the chat real quick. So somebody asked, how much does it cost to structure a Nevis corporation, and how long can non-residents work in the U.S. for? Okay, so let's do the second question first. It depends on the type of visa that they have. And I'm not an immigration attorney, but there's many different types of visas. There are work visas, there's certain types of labor visas or investment visas, and that'll allow you to be in the U.S., I think, as little as 90 days to, potentially a couple of years. And it, puts you on a path to a green card or to citizenship. I really can't get into the different type of visas because, again, I'm not an immigration attorney and I don't want to misspeak, but there are paths to citizenship and there are paths to residency. Now, how much does it cost to structure this? So it depends. It depends on what lawyer you see. I can tell you at our office to set up this whole structure and to make it, tax compliant with the IRS, with all the filings and stuff, we flat fee these at $7,500. So it isn't cheap, but when you think about the tax consequences, it's well worth it. So let's just say we have a piece of real estate that's worth $500,000, right? Pretty easy number to get to these days. So you subtract your $60,000 credit against the tax if you're non-resident, and that leaves you with $440,000 of value that's taxable. So the rate is 40%, right? So on that $500,000 piece of property, 40% of $440,000 is $176,000 you have to give to the IRS. I'll tell you what, I'd rather pay $7,500 to set this up one time and that's it, and not have to deal with FERPTA, which is 15% of the sale. So 15% of 500 is what, $75,000 that you have to give to the IRS if you sell, or if you pass away, $176,000. So with this structure, you completely avoid both. So again, it isn't cheap, but it isn't super expensive either, and it's completely worth it, especially if you have foreign clients that are looking to create a portfolio of investment properties. So you could theoretically multiply this. So this Nevis Corp can own different LLCs that own real estate, and you can multiply this. Let's see, somebody asked, is this corporate structure for both residential and commercial? Yep, doesn't matter. Any type of real estate, whether it's vacant land, multifamily, single family, commercial, anything that's on the ground, this structure will work for it. Let's see. Somebody had asked, if a husband and wife own the LLCs, no Nevis involved, and one of them dies, will they have to pay estate tax? Well, actually. So yes. So let's assume this person LLCs, right, directly, and let's say it was husband and wife. Because they own an interest in a US-based company, they're going to have to pay estate tax because a foreigner owns something in the US. The reason why this works, again, is because this person doesn't directly own anything in the US. He doesn't own this Florida LLC, and he doesn't own this piece of real estate. What he owns directly is this Nevis Corp. So US, taxation doesn't apply to a foreigner that doesn't own anything in the United States. So by virtue of the fact that he owns this real estate indirectly, he avoids that tax. So somebody asked, is there a minimum purchase price to this? No. So you could buy a little condo in the hammocks in Kendall for $200,000, and you could still do this. Doesn't matter how cheap or how expensive the real estate is, the structure will work regardless. Now it needs to be cost effective too, right? If you're going to buy, a piece of vacant land and not going to do anything with it, for like 50 grand, then, maybe it's not worth spending $7,500 on the structure. But if you're going to develop it, that's a different story. So it's just, you have to do that cost benefit analysis, like anything in life. But I will say it's definitely worth it. I mean, why pay something you don't have to? And I know, it's money up front, but you get anonymity with Nevis, you get that estate tax protection. And then by setting up the LLC properly here in the US, you avoid FIRPTA as well. So somebody asked if it's an LLC but taxed as a corporation, will they have members or shareholders? So they're going to be called members because it's an LLC, but it's just for IRS purposes that it's taxed as a C corp. So your typical Florida law will apply, and I personally like to use LLCs, and I'll tell you why, over C corps or even S corps if you're a U.S. citizen. In Florida, if you ever get a judgment entered against you, the person, a judgment creditor could actually take away your shares of a C corp or of an S corp. But that isn't the case in an LLC. So membership interest in an LLC can never be taken away from you from a creditor. So that's why I always like to use LLCs. So the fact that it's taxed as a C corp really has nothing to do with Florida law. That's just an IRS classification of the entity of how it's taxed. So if there's one thing you get out of this class today, is always use LLCs. Never use corps. Let's see if there's any other questions. No. So this is another way of kind of accomplishing the same thing. It's a little bit more complicated. I'm not going to go into this into too much detail, but this is another really common structure that we use. Because a lot of people like to, especially foreigners, they love Delaware. Because kind of like Nevis, like they don't really publish who the beneficial owners are. But I believe there's a law that passed, and I have to double check, where if you own more than a 20% interest in any entity, you have to disclose who the beneficial owners are. So that whole mystique about Delaware is going to come to an end, and very soon. But yeah, this is basically the same thing. So to avoid probate, we have this foreigner that owns a non-US trust. And remember, a trust is the only way you could avoid probate. Even if you have a will, and that's like a really big misconception, you still have to go through probate. All a will does is tell the judge who's getting what, when you pass away. So by this foreigner using this trust, he's avoiding probate because his shares belong to the trust, and the trust again can continue on in perpetuity. But this functions the same way. You got a Delaware corp, they're partners in this Florida LLC that owns their real estate. Again, the Florida LLC needs to be taxed as a C corp, but this basically gets you to the same place, just a little bit more protection because you have another domestic entity that's a partner in this Florida LLC.
Is Uncle Broker taxing your commission too much
without giving the support that you signed up for? Don't be a victim of outdated broker models. It's time for an upgrade.
Here is a golden chance to make 100% commission
with London Foster. London Foster's main goal is to empower an associate and make sure you, the realtor, are getting the most out of your hard work and commission. With an excellent proven track record, latest tools and technology, and exceptional experience, we strive to create the perfect environment for our associate, providing multiple opportunities for you. No hidden fees and no gimmicks. 100% commission for our associates by empowering you with the benefits like
a personalized website with IDX searchability, simulcasting your listing to sites like Realtor.com, Zillow, Trulia, and different search engines for brand recognition. An office at the famous Lincoln Road.
Direct broker support and free weekly and monthly training from Realtor.com and other partners. A personal business trainer resolving all your queries. In-house private equity fund. No waiting on checks. Get it on the closing day.
We understand it's a very competitive market out there. The old broker models don't work anymore. And you deserve more for your hard work. So it's time you give yourself an upgrade with London Foster.
So let's talk a little bit about gift tax. So believe it or not, there is a tax when you give something of value to somebody, and this applies to both U.S. citizens and non-resident aliens. So a non-domiciliary or a non-US citizen is subject to gift tax only on transfers of real estate and tangible personal property in the United States. So gifts of real estate trigger gift tax, and it triggers FERPTA. So if somebody's, looking to avoid probate and they want to, quick claim a piece of property or their kids to avoid it, and you're a foreigner, you're going to implicate gift tax and you're going to implicate FERPTA. Let's talk a little bit about intangible personal property, like bank accounts, corporate stock, mutual funds, bonds, things like that. So if you're a foreigner, that isn't actually subject to tax. So you can have $1 million of stock in Bank of America, let's say. You could give that to whoever you want if you're a foreigner, 100% tax-free. So that's one advantage that they have, that foreigners have with intangible property. So let's go back to this for a second. And let's say the foreigner purchased this real estate, purchased this real estate under an LLC and didn't have the Nevis. Because membership interest in a Florida LLC is an intangible, he could actually gift this to this Nevis Corp that we create after the fact and not pay tax. So it is possible to reverse engineer this. So if you guys have foreign clients that already bought the real estate and it's in their name or they bought it in an LLC, it is possible to do this after the fact. Now you need permission from the IRS, especially if you have the individual owning the real estate directly. But they're going to give it to you. There's just some paperwork that you have to file and something called the non-recognition affidavit that you have to send to the IRS. Is basically documenting the transaction and showing why FERPTA wouldn't apply. But this can be done after the fact. So never have to worry about that. So FERPTA, right? Even if it's a gift and you're not actually receiving money, you're actually supposed to withhold 15% of the fair market value of the real estate if you're going to gift it to somebody, even if it's your spouse. You can't even give it to your kids or your spouse. You still have to withhold FERPTA. Now, how do you enforce this? It's tough, right? The IRS can't police every single transaction. It's basically the honor system. So if you report taxes, then that's usually when you get pegged, I guess, if there's any kind of inconsistency. But yeah, just so you guys are aware, gifts of real estate trigger U.S. gift tax and FERPTA. So let's get a little bit more into FERPTA. So what is FERPTA? So it's the Foreign Investment in Real Property Tax Act. So we'll talk a little bit about the general rule. What are some common exceptions to FERPTA? And we're going to talk about liability of the parties to the transaction when FERPTA applies. So this is straight from the IRS code section. So essentially what FERPTA does is creates a withholding obligation of 15% of the amount realized on the disposition or sale of a piece of real estate. So this is a really complex definition. So let's kind of break it down. So disposition just means sale of real estate. Your U.S. real property interest means any kind of real estate located in the U.S. and the U.S. Virgin Islands, believe it or not. And then a foreign person is a non-resident alien for income tax purposes. And then the transferee is the purchaser and the amount realized is the contract sales price. So unless an exception applies, the purchaser has to withhold 15% of the contract sales price if the seller is a foreign person. So when we talked about the substantial presence test a little while back and the green card test, if you meet one of those two tests, even if you are a foreigner, you don't have U.S. citizenship, this 15% withholding obligation doesn't apply. So that's why it's always good to know ahead of time, who it is that you're working with, so that, what exactly, you have to do in these transactions. Do you withhold? There's also options where you could actually remit the money to the IRS and apply for reduced withholding. And we'll get into that in a little bit as well. So let's talk a little bit about the exceptions to FERPTA. So one is the non-foreign affidavit. I'm sure you guys have all, have seen this if you go to your closings. And if you guys have purchased real estate, I'm sure you've signed this as well. All it is an affidavit that says that you're not a that you're a U.S. citizen or a U.S. resident, and that you're not a foreigner. You have to provide your social security number or ITIN number, and then you have to provide your physical address. So you're just basically swearing, under oath that you are a U.S. citizen and the transaction is exempt from FIRPTA. Most common exception to FIRPTA, if you could even call it that. I mean, if you're a U.S. citizen, it just doesn't apply. You just have to document that you're a U.S. citizen in essentially every single real estate transaction. The other exception is that the purchaser receives what's called the qualifying statement from the IRS. So prior to COVID, this used to be like really, really popular. The problem is the IRS is overworked and understaffed, and they're not getting these things out in time for closing. So it's very rare. I mean, unless maybe you're closing on a commercial deal that, could take 6 months. But it's very rare in the residential world to get one of these qualifying statements from the IRS in time for closing. And we'll get into a little bit more detail about this as well. And then the other big exemption is if the property is sold, doesn't exceed $300,000 of value, and the property is purchased by somebody that's going to use it as their permanent residence or as their primary residence, FIRPTA doesn't apply. Now, I mean, I don't know if this still applies anymore because, real estate is just, it's crazy what's going on down here. So I'm not sure what's under 300K these days, but that exception is still out there. So let's get into the non-foreign affidavit in a little bit more detail. So like I said, it's the most commonly used exception to FIRPTA withholding. The non-foreign affidavit is supplied by the seller to the purchaser. And again, all it states is that the transferor is not a foreign person, essentially not a non-resident alien. You're providing the seller's social security number or ITIN and their home address. And this is what it looks like. So it's basically all that information kind of in an affidavit form. And again, you're basically, swearing under penalties of perjury that the information on the non-foreign affidavit is correct. So a qualifying statement. So like I said, this used to be pretty popular. But the IRS is taking such a long time to get to these that it's almost not even worth it anymore. But all it is a statement from the IRS that says that they've reached an agreement with the taxpayer to pay the IRS. Maybe they got on some kind of payment plan, or that the transaction is exempt from FIRPTA, or that there's been adequate security furnished to the IRS to satisfy the FIRPTA obligation. So the IRS has 90 days to process these requests for a qualifying statement, or at least that's what it says in the instructions. But I'll tell you from practice that they're not getting back within 90 days. And after the 90th day, it's anybody's guess what happens. So what usually happens in these cases is you're selling property at a loss. This is probably the most common thing I could think of. So let's say you bought some real estate for, $200,000, just to, make, math simple. And then you're selling at a loss for $100,000. You still have to withhold 15%, even though you have a $100,000 loss. So you have to remit $15,000 to the IRS as a prepayment of tax, even though you're selling at a loss. So why do that? What's the point? If you're going to get that refund back when you file taxes next year, you're going to get your $15K back. So what you do is you submit a request or a qualifying statement to reduce the withholding or eliminate the withholding. And there's a form that you file with the IRS. It's an 8288B. And you're just asking, hey, IRS, look, here's my closing statement from when I bought this property. It was $200,000, taking a huge loss now. And I'm selling it for $100,000. I'm actually gonna be taking a loss on my tax return. So I don't want to send you this $15,000 for withholding. And then, they'll usually say yes, especially if you're selling at a loss. The problem is, like I said, like I have cases where, it's going on 6 months and they haven't, accepted or denied the request for reduced withholding. Another time you may want to do this too is if the withholding exceeds your capital gain. So what does that mean? So let's say you bought a piece of property for, $100,000, and now you're selling for $150,000. So your capital gain is 50,000. And let's assume, for argument's sake, that it's long-term capital gain, so 20%. So what's 20% of $50,000? $10,000. But what is the FERPTA withholding on the sale of $150,000 property? So 15% of 150 is $22,500. So again, you're overpaying in FERPTA for that tax that you have to pay, the following year. So you're overpaying by $12,500. So in that situation, but yes, you do owe tax, but not as much as the withholding. The withholding of 15% exceeds your 20% tax on your capital gain. So what do? You say, IRS, here's my $12,500 that I owe you. Give me a refund for the other 10,000. Or I'm sorry, let me hold on to the other $10,000 so I don't overpay now. And again, they'll usually get to it and say yes. But these days it's just a little bit tougher because, like I said, the IRS is, I guess, bigger fish to fry these days, especially with the understaffing issues that they have. So let's get into a little bit more detail with the qualifying personal residence exemption. So the purchase price can't exceed $300,000. So the real property purchase must also be the primary residence for the transferee, for the purchaser. And the purchaser has to be an individual. If you're an LLC or a C Corp or an S Corp, purchasing this property, then the personal residence exemption doesn't apply. So the transferee, so the buyer, the purchaser, or members of their family must reside at that property for at least 2 years, and it has to be their primary residence for at least half the time that they're living there. So what does that mean? So the IRS provides that an individual purchaser satisfies this residency test if the buyer or members of his or her family reside at the property at least 50% of the number of days that it's actually used by any of those people during the 2-year period following the purchase. So, this kind of makes sense, right? Let's say you're moving in with your kids and your spouse, and maybe you're the only one on title, and your spouse isn't on title, and your kids might be too young to own real estate. But as long as one of them stays at that property for more than 50% of the time as their primary residence, you satisfy this, even though the person on title might not necessarily satisfy that test. So if you get those two things, not exceeding 300K, and you get that residency test satisfied, you don't have to withhold for FERPTA. And there is a little nuance to this rule too. So let's say the purchase price exceeds 300 but doesn't exceed a million, then you actually only have to withhold 10%, but it's 10% above 300,000. So between 300,000 and a million, that's what is going to be withheld. So it gets reduced a little bit from 15, but these other requirements still apply. So you still have to live in the property at least 2 years after you purchase it, and it has to be used as your primary residence at least 50% of the time. So yeah, again, this is also a pretty common one. So yeah, we talked about this just now, the qualification for 10% withholding. So again, the buyer has to use it as a personal residence. The amount realized or the contract purchase price has to be $1 million or less. And the qualifying personal residence exception does not apply. So it has to be a personal residence. So real property owned by foreign and non-foreign owners. So withholding is also based on the capital contribution to the real estate. So let's say you own property 50-50 with a foreigner and you're a US citizen. That calculation is only determined by the ownership interest that foreigner has. So if you own, let's say I own a property with some foreigner, and we both put in $100,000 into it, bought the real estate for a total of 200, and now we're selling it. for 200, just to keep the math simple, we only have to withhold on 100,000, which is his half. So instead of withholding $30,000, we only have to withhold 15. So I get my money when we sell. The foreign, my foreign partner, either he applies for a withholding certificate or he just remits the full 15 to the IRS within 20 days of closing. And, he does what he's got to do. So another kind of little nuanced thing too is that property that's owned by a husband and wife, even if it's like tenancy by the entirety, it's presumed to be 50-50 ownership. So if you have one spouse is foreign and the other one's a U.S. citizen, you actually do have to withhold for that foreign spouse. So that's one little nuance with FERPTA and spouses. Let's take a look next. Let's talk about gifts. So I said this a little bit earlier. So there are some rules on gifts of real estate. So gift transfers are subject to FERPTA. So under the general rule, a transfer is defined as any person, foreign or domestic, that acquires a U.S. real property interest by purchase, exchange, gift, or any other transfer. So even if you're transferring to your spouse or your kids, you're doing some kind of estate planning, you still have to withhold the 15%. So not even gifts to your spouse or your kids are exempt from FERPTA. But again, it's kind of the honor system. I mean, you're supposed to report, any kind of, movement, to the IRS. So somebody asked why 15% in the 200K example if there was no gain. So it doesn't matter that there's no gain. Anytime a foreigner sells real estate, whether it's at a gain or a loss, under FERPTA, we're required to withhold or remit 15% of the sales price. So in the 200K example, if you have a foreigner that owns 100% of that real estate and he bought it for 200 and he's selling for 200, you still got to withhold 15%. Just like what I said earlier, like if you bought for 200 and sell for 100, you got to withhold $15,000 even though you're selling at a loss. Now, again, there's ways around it, like I was saying with the non-recognition affidavit. But the problem there is, like I was saying, is the IRS takes a really long time to respond to those requests, and you might not make it to closing. I mean, think about it. If they have 90 days in a non-COVID year or a non-COVID, era, essentially, 90 days to process that request. I mean, most residential sales are closing between 45 days and 60. So unless you have like a really, really cool buyer that's willing to wait around, it's probably going to take at least 4 to 6 months for the IRS to process the request. And like I told you guys earlier, I did one in April of last year and I still haven't heard anything. So we wound up just sending the money to the IRS anyways to avoid penalties. So it's really tough to get those things processed right away and to do it in time for closing. I honestly would only do it if we're dealing with, residential or maybe like pre-construction, like something that's going to take a while to close on. Because at that point, you could afford to wait, 6 months or so. But if it's like a regular, purchase and sale of residential, it isn't worth it. You're better off setting up the structure that I had explained earlier. That way you could just close and you don't have to worry about waiting for anybody. And you don't even need IRS approval when you set up that structure. You just do it like any other deal. So someone was saying you withhold that close, but if seller gets the qualifying statement later, they can get a refund. So the way the qualifying statement works is this. You're going to have your closing agent hold on to the money. So typically when you have a FERPTA transaction, you withhold 15% at closing and you send it to the IRS within 20 days of closing. But when you're trying to get a reduced withholding certificate, because again, you're either selling at a loss or even if you're selling at a gain, the withholding exceeds the tax, the closing agent is actually going to hold on to the money and wait for the IRS to respond to your request. And then the IRS will say one of two things. Either you're right, it's exempt from FERPTA, or you're entitled to a reduced withholding because the withholding exceeds the tax, or they'll say, no, send over the money. So at which point either the closing agent's going to disperse some of the money if there is a tax, but again, the withholding exceeds the tax, so they'll send some of it and then give the rest of it back to you. Or you're going to get 100% of it back in the case that you're selling at a loss. But the idea is that it's better for your attorney or for the closing attorney to hold on to the money than the IRS. Because if you send it to the IRS, then you have to wait around, potentially 2 years to get that money back, because you have to file a tax return and then you have to get a refund. And I don't know about you guys, but well, I guess you guys probably don't get refunds, right? You guys are all 1099s essentially with your commission, but like most people that are W-2, like they weren't getting their refunds until late last year, and they were filing on time, before April. But when you're dealing with a foreigner, the IRS takes much, much longer. And a lot of times when people are closing, like these foreigners are closing, they don't have ITIN numbers. So the IRS is going to get this lump sum of money from somebody that doesn't have a social security number or an ITIN number, so they can't really identify who is sending this money. And then this foreigner has to keep, receipts and document the transaction, to the T, and then apply for an ITIN number so they can file taxes the following year and try to get this refund. And that takes a long time. So that's why I was saying in the beginning of the class, like if you set up a structure to avoid all this stuff, you don't have to worry about filing. And you don't have to worry about withholding because it's a U.S. entity that's selling real estate. But I want to say like 90% of the time, the foreigners that bought the real estate don't have any kind of ITIN number. So, and when they sell, they don't have an ITIN number either. So they'll put on the forms like applied for an ITIN number. But good luck. I mean, the IRS has to figure out who that money belongs to. So it's just going to take a really, really long time. Somebody asked if the seller is not a citizen or a legal resident but lives in the U.S. for a long time, is it considered FIRPTA? So then that goes to the substantial presence test. So if you're in the U.S. for 183 days out of the year, and obviously there's that whole look back period of 3 years, then FIRPTA doesn't apply. And it doesn't matter if you don't have a green card. You can be here illegally, but if you're here in the U.S. for at least 183 days, no visa, no green card, no nothing, FIRPTA doesn't apply to you because you're considered a U.S. citizen for income tax purposes or for FIRPTA purposes. Let's go to the next slide. So let's talk a little bit about trust. So a lot of people think that if you set up a trust that you avoid taxes, that there's all the secrecy and nobody could touch you. So that's like a really big misconception, especially when you're dealing with like foreign trusts or foreign individuals that own property through a trust. So this is a little bit complicated, so I'll probably repeat it a couple of times, but essentially trusts do need to withhold if you're a foreign trust. But how do you classify a foreign trust? So in order for a trust to be classified as domestic or foreign for U.S. Income tax purposes, the trust has to satisfy two tests. One is called the court test, and the other one is called the control test. So as simply as I could put it, the court test just means that a court in the United States is able to exercise jurisdiction or supervision over the administration of the trust. So if somebody forms a trust and it's formed under Florida law, it satisfies the court test because U.S. law applies to that trust. But it also has to satisfy something called the control test. So what does that mean? So one or more persons have the authority to control all the substantial decisions of the trust. The simplest way I could say this is you have to have a U.S. trustee. There's like certain nuances to this as well, but just to kind of get the point across, that's essentially how these tests work. So the law that regulates the trust is U.S. law, and the person that controls the trust or the trustee is a U.S. person. You have to have both of those things to be considered a U.S. trust. If you fail one of those things, you're considered a foreign trust. So if you form your trust in Mexico and Mexican law applies to the trust, but John Smith, who is a citizen of the United States, is your trustee, does it matter that John Smith is your trustee? You're going to be considered a foreign trust. And then the reverse is true. If U.S. law governs the trust, but Pepito Suarez, who's in Mexico, is controlling the trust because he's the trustee, same thing. You're considered a foreign trust. So do trusts need to withhold? The answer is yes. If you're a foreign trust, you have to withhold. So again, getting a little bit more detail, a court test. So if a trust is governed by U.S. law, so i.e. the laws of a state in the United States, and is actually administered exclusively in the U.S., it'll satisfy the court test. So let's say you have somebody that set up the trust, and it's supposed to be U.S. law that's governing the trust. That's what the trust says. But they're over in like Guyana or something, like administering the trust. It won't necessarily satisfy it, even though you have U.S. law governing the trust. Again, that's like really nuanced. Isn't necessarily something you guys need to worry about, but it's something you should know about in case you're dealing with a listing where you have a trust as the seller or a trust as a buyer. And then the control test, same thing, requires that a U.S. person has authority to control all the decisions of the trust. And what is a substantial decision? A substantial decision means a decision that a person is authorized or required to do or make under the terms of the trust agreement and the applicable law. So let's talk a little bit about liability. So bottom line here is the IRS is always going to get their due. So if you're a closing agent, so you're a title company, and the seller provides false information on the non-foreign affidavit, the closing agent has to notify the IRS and the buyer right away. And if they fail to do that, they're actually responsible for withholding the tax. So they're going to get pegged. And then failure to withhold by a closing agent or an escrow agent can result in them paying the tax and potentially paying, penalties. Now, if you're the buyer, so the buyer technically has the duty to withhold, because they're the ones that are giving the money to the seller. So failure for the buyer to withhold on FERPTA could result in them paying the tax as well. And they could also potentially pay interest and penalties. So it's very important that, prior to closing, you figure out who's who in the transaction. Are we dealing with a foreign person? Are we dealing with a foreign entity, a foreign trust? It's good to get that out of the way. That way you can get to the closing table and not have to deal with this stuff. I get brought in on cases all the time to try to figure all this stuff out. And it's, like a week before closing, and people don't know if they're dealing with a foreign entity or not. Or people don't know if a person's a U.S. citizen for income tax purposes or not. So definitely get ahead of the game and, figure all that stuff out, prior to closing. And hopefully, prior to even making an offer on a contract or listing if, you're representing a seller. So again, like some practicing tips, like ask your seller clients if they're non-resident aliens. And if you're not sure if they meet the green card test, so you have a green card, or the substantial presence test, which was that test that you're in the U.S. for 183 days, ask an attorney, ask a CPA. Definitely get ahead of the game, like I was saying, because it's just going to make the closing process, that much easier. I actually had a client that was a foreigner, has owned real estate here for like over 20 years, and she owned it in her name, and then she died. And now the kids are trying to sell it, and they didn't know about any of this stuff. So estate tax applied and FERPTA applies. So now we have to probate the property. We have to pay tax to the IRS, and it's completely holding down the closing. And these guys went under contract in January, and they're looking to close now in September. And it's a condo here in Miami. It's, nothing big. I think it's like $540,000. But it's slowing down closing. So had that person bought this condo in that structure that I showed you guys earlier, it's going to save a ton of time and avoid paying taxes. So like I said, what was it? $176,000 is the tax hit if you own some real estate here that's worth $500,000. So that's essentially what needs to be paid, and all of that could have been avoided. I see something in the chat. Oh, never mind. This is Memo. So yeah, definitely ask. Definitely ask and make sure that they meet one of those two things, either green card holders or substantial presence test, because otherwise you're going to be stuck. And you have to deal with probate and all that, and it's just going to take forever. So just some fresh stuff I have to get out of the way. As real estate licensees, you can't engage in the unlicensed practice of law. So this course is just designed to help you guys spot issues when you're listing or selling property that's owned by a foreign person. So don't put on your attorney hat, but like if you see one of these issues pop up, like, you're dealing with somebody that's a foreigner, just, I guess, think about this and say, you know what, you should probably speak to an attorney before we move further, so we could structure the transaction in a way to avoid some of these, taxes or avoid withholding. So you guys should have a basic understanding of FERPTA and, certain tax consequences when we're, buying and selling real estate or even gifting real estate. And you should have a pretty good understanding of what structures we could use when acquiring property. But again, don't give legal advice. If anybody asks you, just say, hey, look, I see this. I heard about using this structure to avoid some of these taxes. Let's speak to an attorney to get this done. But yeah, definitely have this stuff in the back of your mind. And we have a little bit of time. And like I said earlier, I saw I'm a probate attorney. So I want to show you guys really quickly how to look for probate leads. But first, let me see, is there any other questions? Oh, no. Does anybody have any questions about the material before I move on? No. Oops. So I want to show you guys how to look for probate leads in Miami-Dade County. So typically what you want to do is, and this works for any county, but I just like to use Miami-Dade because I live here. So you're going to go on the property search page. You're going to search, make sure it says owner, and you're going to type in EST, short for estate. And look, here already popped up Gonzalez, but you could use any last name, any letter of the alphabet, whatever you want. And then whenever this thing decides to load, it's going to show you every piece of real estate that's owned by somebody that's deceased. So here we have, what is this, Eleazar Gonzalez. So when you see this, you know that the owner is dead. And typically, and this is actually a pretty good probate lead. And this is why. So we have the property address up here, but look where the mailing address is. It's in Pembroke Pines. So either this unit is vacant and like the kids just changed the mailing address on there to get, mail, or they're renting it out. But this person here owns the real estate and they're deceased. And another thing we could check out as well is here, like the homestead information. So they're clearly not taking homestead. So this person may have been deceased for a while. And if we look here on the exemption stuff, look at it, they didn't take it in 22, 21, or 20. So they may have been dead for a couple of years. And another way we could check it is if we go to the property taxes here. And it'll take us to the tax bill. And we could actually go as far back as we want to see when it was that they were taking homestead on it. Oh, wow, this guy's probably been dead for a while. Look at that, a tax certificate was issued. And you could also see, like, when the taxes start to spike up, they probably stopped taking homestead. So this person's been deceased for a little bit, it looks like. And the way you want to check to see if an estate has been opened is, now that we have this information, and this potentially is like a good lead, you're going to want to go to the Miami-Dade Clerk of Court's office, their website. So you just, Google miami-dade-clerk.gov or just go on miami-dade-clerk.gov, and this is their homepage. And then you're going to want to hit records, search records, And then you're going to go to where it says Civil Family Probate Court Online System. So you guys will hit standard search because you're not attorneys. But it shows you the same information. And then where it says party search, you're going to type in the name. So what was it? Eleazar Gonzalez. You're just going to type it in here. And then where it says code, you're going to select DC for decedent. So somebody that passed away. You just run the search and nothing. No cases have been opened. So this is actually a good thing. This means that this person doesn't have an estate open and they're deceased and they own the property. So if this guy ever wants to sell this property, they're going to have to go through probate in order to sell. So they need to change title. So this potentially is a pretty good lead. Let's try one more and then I'll let you guys go. Actually, let me see if there's. So once you have this info, how do you contact the estate? So you could do one of two things. We know this person is getting mail here, right? Because they took the time to change the mailing address of this property. So somebody here is receiving mail. So you could send out mailers to them. And that's probably one of the best ways to get in contact with them. Or if this search had a case and there was a probate open, you can actually contact the attorney. And let's see if we can find one like that. I remember seeing another one here, putting in estate of Gonzalez. Okay, let's try this one. Yolando Sorondo Gonzalez. So look, the property address and the mailing address is the same. And if we look at this, they were taking homestead on it. So this person may have died recently. And when did they buy this? In 2021. So it looks like this could be, potentially a fresh probate. But now let's double check it. So Yolanda Gonzalez. This is a really common name, so we might see a couple of cases. Let's check it out. Same thing, make sure you put DC for decedent. You run your search down here. And look, Yolanda Gonzalez, 2017, and a Yolanda Virginia Gonzalez, 2021. Let's look at this one because we know this one isn't the case, but so you're going to scroll down and you're going to look at the petition for administration when you have something like this to kind of get some information. Because this tells you everything about the case. It tells you who the heir is, so Orlando Gonzalez. And then the decedent is Yolanda Gonzalez. You have her address, when she died. So died 2013. So this isn't the same one as this one. Whoops, as this one. That's pretty clear. It's a different Yolanda Gonzalez. But just to illustrate the point, this petition for administration gives you all the information that you need. So the assets of this estate has the address right there, has some personal property, some shares of stock. Like, it gives you an inventory of what's going on here. And if you ever wanted to, this estate is closed, but if you ever wanted to see if you could get in with the attorney to list the property, got the information down here. So you contact Lewis Hillman and say, hey, I want to be your listing agent. What can I do to get on your wheel? And that's how you can get some probate leads that way. But it looks like this probate hasn't been opened up either. So like I said, if this person got the property in 2021, so recently, they probably haven't been dead for a long time. Plus, they're still taking homestead on it. So yeah, look at that, widow, long-term resident, senior, like they're taking a bunch of stuff on it. So this potentially could be a good lead too, but in this situation, you either have to send them, a mailer, or you just knock on doors And that's another thing you could do to get that lead. But this is kind of another one that's like ripe for the taking. So somebody asking, you just put EST or state in the search, or do you need the last name also? So it depends on the county. The tax collector's office typically puts EST in date. So you're going to want to put EST of, and then you could type in G, or, you know, what's another one? Let's see, like Garcia. And then you'll get a list of properties where somebody is deceased. There's an estate, like Jose A. Garcia, estate of Carlos Garcia, estate of. I mean, you can get some other stuff too. Oscar J. Garcia, estate of. But you're going to get a lot of, you know, potential probate listings here. I think in Broward, if you type in, you know, the full word estate, you'll get it. But every county is different. It really depends on whoever was updating the public records that day, if they decided to put EST or EST ATE. But you could also do G. Let's try A. You could do a letter. But this is going to be a very broad search, so you're probably going to get like a ton of listings. And it won't be as specific. Here you go, Gene Augustine estate of. So you could do that as well. So you could play with it, and you'll be able to find some potential estate listings. So Ann Hawkins estate of. And then again, you cross-reference this with the clerk's website, like I showed you, and that's a good way to potentially get some probate listings. So that's pretty much it for me, unless anybody has any questions on any of the stuff that I went over. But that's it for me. Let's see. And I'll stick around for a little bit if anybody has any questions they want to type in the chat. Let me put in my email. And then the secret password is probate. So email me today before 5 if you want credit, and make sure you put probate in your message along with your first name, last name, and your license number, and I'll give you guys your 2 hours of CE credit. Also, just put in my direct line as well. So if anyone ever has any questions ever, feel free to give me a call on my direct. I'm more than happy to take your calls.
Thank you.
All right. Well, guys, thank you so much for participating. Stephen, thank you so much for this amazing training. A lot of really good tips. I think a lot of people were taking a lot of notes. I saw a lot of people's heads down, so that's actually really great. Guys, as you know, all of our videos are recorded and they are provided for you in the London Foster back office under education, including the PowerPoint that Stephen has shared with us. For those of you that have been attending and have been paying attention, thank you so much for doing that. Those of you that shared your screen, we so much appreciate it. But more importantly, guys, in order to get the continuing education credit, he has given the password. The word is probate. Just write it in the title section of the email, and then include your first name, last name, and your license number. So it makes it easier for Mr. Stephen Gurian to provide us with this great benefit of getting 2 hours towards our credit with the licensing bureau. So once again, I want to thank everyone. Stephen, great to have you. Please, guys, this is a great opportunity for you to show your thanks. Is if you have an opportunity for probate or an opportunity for Stephen and easy probate. What is it called?
Easy estate probate.
Easy estate probate.
We make it easy.
There you go. Got to put in your auto signature, because that's the way that's it. Yeah, it's not in the brain and it's going to be forever. Easy estate probate. There we go. So guys, just make sure that you reach out to him and provide him with any information. I'm sure he's going to be more than happy to help you guys out. Once again, thank you so much. The video will be there as soon as I get to it. Thanks. Now, guys, it takes like around 5 days. We have a video editor that does this for us. So it takes like around 5 days. Probably by Monday, it'll be there. Okay. So thanks, guys, again. And thank you, everybody, for participating. Stephen, thank you so much. And thank you to Bobby. I don't know if he was on the call or not, but Bobby, because he's the one that funds and does all of this and make sure that we get all the advertising out so that we have all these agents show up. And we had over 100 RSVPs, and I think at one point we had like 40-something people on the call. So that's excellent. Once again, guys, thank you so much and have a great day. Take care. And for those of you that are not London Foster agents, I invite you to visit our website. It is www.joinlondonfoster.com. You can find out more about the company under the FAQ section and also request a phone call, and I'll be more than happy to call you and tell you all about the London Foster 101, which we'll be doing tomorrow, Thursday, 7 p.m. All right, guys, have a great day. Take care.
Is Uncle Broker taxing your commission too much?
Without giving the support that you signed up for. Don't be a victim of outdated broker models. It's time for an upgrade
Here is a golden chance to make 100% commission.
with London Foster. London Foster's main goal is to empower an associate and make sure you, the realtor, are getting the most out of your hard work and commission. With an excellent proven track record, latest tools and technology, and exceptional experience, we strive to create the perfect environment for our associate, providing multiple opportunities for you. No hidden fees and no gimmicks. 100% commission for our associates by empowering you with the benefits like
A personalized website with IDX searchability, simulcasting your listing to sites like Realtor.com, Zillow, Trulia, and different search engines for brand recognition. An office at the famous Lincoln Road.
direct broker support and free weekly and monthly training from Realtor.com and other partners. A personal business trainer resolving all your queries. In-house private equity fund. No waiting on checks. Get it on the closing day.
We understand it's a very competitive market out there. The old broker models don't work anymore. And you deserve more for your hard work. So it's time you give yourself an upgrade with London Foster.